You know that feeling when you open your brokerage app for the third time today, see your portfolio is down 2%, and your finger hovers over the sell button? Your heart's racing, palms are sweaty, and you're thinking maybe you should move everything to cash just to feel safe again. That anxiety, that's the feeling of watching your money in real time, and it's costing you everything. Now imagine that feeling, but it's your $400,000 retirement account. And you just realized that by checking it every single day and making smart adjustments, you've underperformed someone who literally forgot their password by $73,000 over the last decade. This isn't a hypothetical. It's happening to millions of investors right now. Let me show you how. The most active investors, the ones reading financial news every morning, the ones rebalancing monthly, the ones who think they're being responsible, are getting destroyed by people who set up their accounts in 2008 and haven't logged in since. But here's what nobody's telling you about why your intelligence is actually the problem and how the entire financial advice industry profits from keeping you anxious and active. My name is Tom, and I spend way too much time thinking about why smart people make terrible financial decisions. If you're someone who's ever felt like you're working harder on your investments than everyone else, but somehow getting worse results, make sure to hit that subscribe button and give this video a thumbs up if this helps you out. By the end of this video, you'll understand the exact psychological trap that financial media, brokers, and advisors use to turn your natural intelligence into their profit machine, and why the most successful investors are the ones who literally do nothing. First, I need to tell you a story that seems completely unrelated. Let me tell you about long-term capital management in 1998. This wasn't some random hedge fund. This was a firm run by two Nobel Prize winners in economics, a former vice chairman of the Federal Reserve, and some of the most brilliant mathematicians on Wall Street. They had PhDs from MIT, computer models that predicted market movements, and they were making returns of 40% per year. Everyone on Wall Street wanted to be them, until they lost $4.6 billion in 4 months and nearly crashed the entire global financial system. Here's how it happened. Step 1, they built incredibly complex mathematical models that identified tiny price differences between bonds. Step 2, they borrowed massive amounts of money, sometimes $125 for every $1 they had, because their models said the risk was minimal. Step 3, they made tons of small, guaranteed profits for years, which made them even more confident in their system. Step 4, Russia defaulted on its debt in August 1998. Markets panicked in ways their models said were statistically impossible, and suddenly their borrowed money became a death sentence. Now, why would the smartest people in finance do this? Because they believed that more analysis, more data, more intelligence meant less risk. They thought they could outsmart randomness itself. But here's the catch. While they were building supercomputers to find arbitrage opportunities, a school teacher in Ohio who put $10,000 into an S&P 500 index fund and forgot about it made 12% that year. She did literally nothing. She didn't even know what arbitrage meant, and she outperformed Nobel Prize winners. In September 1998, long-term capital management collapsed. The Federal Reserve had to organize a $3.6 billion bailout because if LTCM went bankrupt, they'd have to liquidate positions so massive it would crash markets worldwide. The Nobel Prize winners lost everything. The banks that lent them money lost billions. And here's the kicker. The people who profited were the ones who weren't paying attention. The passive investors who were too busy with their actual lives to notice the crisis made money that year because they didn't panic sell. So what does this have to do with your portfolio? Everything. Just like those Nobel Prize winners believed that more intelligence and more activity meant better results, you're being sold the same lie every single day. And just like the banks profited from both the rise and the collapse of LTCM by collecting fees and interest, your broker and financial advisor profit whether you make money or lose it, as long as you keep trading. Imagine you own a garden. You plant tomato seeds. Every day, you dig them up to check if they're growing yet. You measure the roots, adjust the soil chemistry, move them to different spots based on that day's sunlight patterns. You're working incredibly hard. You're being attentive. But the tomatoes die because you keep disturbing them. Meanwhile, your neighbor plants seeds, waters them weekly, and ignores them. 3 months later, your neighbor has 50 pounds of tomatoes worth $200 at the farmer's market. And you have dead plants and a bunch of gardening books you spent $300 on. You worked 10 times harder and got negative results. This is exactly what's happening with your investments. The garden equals your portfolio. Digging up the seeds equals checking your account daily. Adjusting the soil equals rebalancing based on market news. Your hard work equals trading activity. The dead plants equal underperformance. Your neighbor's 50 pounds of tomatoes equals the 7 to 10% annual returns that lazy investors earn by doing nothing. When you keep interfering with your investments because you think you're being smart and proactive, you're actually killing your returns. Now let me tell you who benefits from convincing you that activity equals intelligence. Every financial media company, every brokerage app, every investment advisor who charges by the trade or by the hour, they need you to believe that successful investing requires constant attention, frequent decisions, and expert guidance. Why? Because Charles Schwab, Fidelity, TD Ameritrade, they all profit from your activity. When markets go up, you trade because you're excited and want to chase winners. You generate transactions, they collect fees. When markets crash, you trade because you're terrified and want to protect yourself. More transactions, more fees. They literally cannot lose. They collected $11.3 billion in trading fees and advisory fees last year, regardless of whether their customers made or lost money. Here's what they're not telling you. First, they designed their apps with green and red colors, real-time updates, and push notifications so that you feel like investing is a video game that requires constant engagement, when really checking your portfolio more than once a quarter actively hurts your returns. Second, they publish articles with titles like 3 stocks to buy now and Is it time to sell tech, which creates urgency and makes inaction seem irresponsible, when decades of data shows that reading financial news is negatively correlated with investment returns. Third, they've normalized the idea that you need to beat the market and that 7% annual returns are somehow disappointing, ensuring you're never satisfied with simple index funds that would actually make you wealthy, because satisfied customers who buy and hold don't generate trading fees. You're not investing, you're being farmed for transaction fees. This isn't wealth building. It's a psychological extraction system designed to monetize your anxiety. They're not helping you get rich. They're getting rich by making you feel poor unless you keep trading. Look, here's what you need to do today to protect yourself. Go into your brokerage account right now and check how many trades you made last year. If it's more than 4, you're actively destroying your returns. Vanguard did a study of 5 million accounts and found that the investors who made 0 trades during the 2008 financial crisis had average returns of 18.2% over the next 5 years. The investors who traded more than 10 times during that same crisis, negative 3.4% returns. The difference between doing nothing and managing your portfolio actively was over 21 percentage points. On a $200,000 portfolio, that's a difference between having $376,000 and $187,000. The lazy investors earned $189,000 more by literally forgetting their password. Here's the second thing. Delete your brokerage app from your phone. I'm serious. Studies show that people who can check their portfolios instantly check them an average of 4 times per day. Each time you check, there's a 53% chance you'll see a loss, because markets fluctuate randomly in the short term. Each time you see a loss, your brain releases cortisol, the stress hormone, which makes you more likely to make emotional decisions. This is called myopic loss aversion, and it's the main reason active investors underperform. In one study, investors who could check their portfolios daily earned 3.5% per year. Investors who could only check monthly earned 8.1% per year. Same markets, same stocks. The only difference was how often they looked. Looking at your investments literally costs you money. And third, automate everything. Set up automatic monthly investments into a boring 3-fund portfolio. Low-cost total stock market index, total international index, total bond index. That's it. No individual stocks, no sector funds, no trying to find the next Amazon. Automation removes emotion. You're not making decisions when you're scared or greedy. You're just executing a plan. Vanguard found that investors using automatic investing earned 2.89% more per year than investors making manual contributions, specifically because they didn't stop contributing during market crashes. Now you might be thinking, wait, if I'm not paying attention, won't I miss opportunities? Won't I buy at the top of a bubble? Here's what most people don't realize. The opportunities you think you're catching by staying active are statistical noise. From 1950 to 2023, if you invested $10,000 in the S&P 500 and held it, you'd have about $6.7 million. If you missed just the 10 best days in that 73-year period, days you would have missed because you were in cash waiting for a better entry point, you'd have $3.2 million. Missing 0.03% of trading days cut your returns by 52%. You can't time the market. Nobody can. Not Nobel Prize winners with supercomputers, not billionaire hedge fund managers, and definitely not you reading headlines on your phone. But here's where it gets really interesting. The psychology of why lazy investing works is completely counterintuitive to how our brains evolved. Your brain was designed to survive on the African savanna 50,000 years ago, where immediate threats required immediate action. See a lion, run immediately. See a snake, jump immediately. Hesitation meant death. So your brain is literally wired to believe that doing something is always better than doing nothing in the face of danger. When you see your portfolio drop 5%, your amygdala, the fear center of your brain, activates the exact same circuits as seeing a predator. Every instinct tells you to act, to do something, to protect yourself. But markets aren't lions. Markets are random in the short term and predictable in the long term. Acting on short-term fear is the financial equivalent of running away from a rustling bush that turned out to be wind. You expend energy, you change your position, and you're worse off. The investors who win are the ones who can override their evolutionary programming and do absolutely nothing when their instincts scream at them to act. There's a famous study from Fidelity where they analyzed which accounts had the best returns over a 20-year period. Want to know who won? Dead people. Literally, the accounts of people who had died and whose families forgot to close the accounts had the highest returns because nobody touched them. Second place went to people who forgot they had accounts. Living, active investors came in third. Your grandparents who bought stocks in 1970 and put the certificates in a drawer and forgot about them accidentally became millionaires. You, with your real-time data and sophisticated analysis, are struggling to beat a savings account. Let me give you another concrete example of how this plays out in real life. Say you have $100,000 in 2009, right after the financial crisis. The markets crashed 50%, everyone's terrified. Financial media is saying we're entering a depression. Investor A, the active one, thinks he's being smart. He moves to cash to preserve capital and waits for things to stabilize. He's glued to CNBC every day, reading analysis, trying to figure out the perfect time to get back in. March 2009 comes, the market starts recovering, but he's not convinced. It could be a false rally. He waits. By the time he's comfortable getting back in, it's September 2009, and the market's already up 35% from the bottom. He invests his $100,000. By 2019, it's grown to $312,000. Not bad, right? He more than tripled his money. Investor B, the lazy one, had the same $100,000 in 2009. She was too busy with her job and her family to pay attention to the news. She had set up automatic investments years ago and forgot about it. Her portfolio dropped 50% too, down to $50,000 on paper. But she never looked, so she never panicked. Her automatic investments kept buying more shares every month while prices were low. By March 2009, when the market bottomed, she'd bought shares at incredible discounts without even realizing it. When the recovery happened, she didn't need to time it because she was already invested. By 2019, her account was worth $547,000. She earned $235,000 more than the active investor by doing absolutely nothing. This isn't a hypothetical. This is the actual math when you compare investors who stayed invested through 2008 versus investors who went to cash and tried to time their reentry. The lazy investor beat the active investor by 75% simply by being too distracted to panic. Now here's the really maddening part. The financial advice industry knows all of this. They have the data. They know that active trading destroys returns. They know that checking your portfolio frequently leads to worse decisions. They know that trying to time the market is statistically impossible. But they can't tell you to do nothing because there's no money in nothing. If they told you the truth, which is invest in index funds automatically and don't look at it for 30 years, you'd set it up once and never need their services again. They'd make the tiny fee on your index funds once and that's it. Instead, they need to convince you that markets are complicated, that you need expertise, that this time is different, that you should be worried about inflation or deflation or geopolitical risk or sector rotation or whatever the crisis of the week is. Not because any of that actually matters to a long-term investor. It doesn't. But because keeping you anxious keeps you engaged, and keeping you engaged keeps you trading, and keeping you trading keeps you poor while making them rich. Morgan Stanley put out a research report in 2022 that accidentally revealed this whole game. They found that their clients who interacted with their advisor more than once per quarter had average annual returns of 4.1%. Clients who interacted with their advisor once per year had average returns of 7.3%. More advice meant worse returns. The report was quietly removed from their public website after 3 weeks. I wonder why. Here's another thing nobody talks about. The tax consequences of active trading are catastrophic. When you're constantly buying and selling, you're generating short-term capital gains, which are taxed at your ordinary income rate. For most people, that's 22 to 37%. Compare that to long-term capital gains if you hold for more than a year, which are taxed at 0 to 20% depending on your income. On a $50,000 gain, the difference between short-term and long-term treatment is about $8,500. That's $8,500 that the active trader gives to the IRS that the lazy investor keeps. Vanguard calculated that tax loss harvesting, which is a sophisticated strategy that requires active management, adds on average about 0.35% to annual returns. But the behavioral cost of having someone actively managing your portfolio, checking it frequently, making trades, costs an average of 1.5% per year in poor timing decisions. You're paying 1.15% per year to have someone actively manage your portfolio, even if they're theoretically doing a smart strategy. You'd literally be better off doing nothing. Let me tell you about my uncle. Back in the 90s, he was convinced he was going to get rich day trading. He quit his job as an engineer making $78,000 per year because he'd made $32,000 in his first 3 months of trading and thought he could scale it up. He was smart. He had spreadsheets. He had technical analysis software that cost $6,000. He was reading 5 different trading newsletters. He was working 12 hours a day, completely focused. After 2 years, he'd lost $160,000 and had to go back to engineering. His wife had kept her job and had been putting $400 per month into her company's 401k in an S&P 500 index fund the entire time. She literally never thought about it, just automatic payroll deduction. Those 2 years, her account grew by $17,000. She worked her normal job, spent time with her kids, had hobbies. He sat in front of screens having panic attacks and lost everything. Intelligence and effort meant nothing. Actually, they meant less than nothing because they prevented him from doing the obvious, simple thing that worked. This is what I mean when I say that laziness is a competitive advantage in investing. The less you do, the less you think about it, the less you try to be clever, the more money you make. It's completely backwards from every other area of life. And that's exactly why smart people struggle with it. In your career, working harder usually means earning more. In fitness, training harder usually means better results. In relationships, putting in more effort usually strengthens the bond. But in investing, trying harder makes you poorer. There's a concept in Taoism called wu wei, which means effortless action or non-doing. The idea is that the most powerful force is water, which doesn't try to overcome obstacles, it just flows around them. Over time, water carves through mountains, not through force, but through persistence and patience. That's what lazy investing is. You're not trying to outsmart the market. You're not trying to find shortcuts. You're just consistently flowing capital into productive assets and letting time do the work. The active investor is trying to punch through the mountain. The lazy investor becomes the water. Look, I get that this is frustrating to hear, especially if you've spent years reading financial books, watching market analysis, building spreadsheets to track your portfolio. You want to believe that all that effort means something. But here's the truth. In the stock market, effort and intelligence are not just uncorrelated with results, they're negatively correlated. The harder you try, the worse you do. Because trying means trading, and trading means fees, taxes, and behavioral mistakes. The single best investment decision you can make is to set up automatic contributions to a 3-fund portfolio, delete your brokerage app, and spend that time and mental energy on literally anything else. Start a business, learn a skill, spend time with your family, work on your actual career, where effort actually matters. That's where your intelligence creates value. Staring at stock charts creates zero value and destroys wealth.